All right, guys. If it's Tuesday, there's a class. We're recording it. The date's what are we? April 7th, 2015. And I've kind of did an impromptu class, not an impromptu class, but the title of this, I was going to go over some more video clips, but we had such a good transitional day a few different times. I want to go specifically over those examples of how to be able to recognize as real time as possible changes in biases. I've always said the best opportunity you're going to have is when biases change, when the actual market changes from bullish to bearish back to bearish. So when the fruit is lowest on the tree, that's when you're going to see your best trade locations surface, but you got to get good at not thinking too hard about it, not trying to find the transition, not having to say, is this a transition? Is this the turn? Is this the turn? Because your mind will just eventually say, yeah. It'll eventually want to get you around to, yeah, this is the turn. Get bearish, get bullish. You want to see it pop, but you can't wait for it to be obvious because then you miss the turn or the opportunity. So there's always a sweet spot for everything, and there's a sweet spot in trying to recognize when a transition has possibly happened. But before we get into these slides, and I'm going to go over charts from today, specifically the three transitions we have, so they're not one of those easy to recognize after the fact. We articulated them through real time in the room. You guys got to get good, but it brought me to an exercise alert. That's what I'm going to call them. When I think of something that people should do, I'll tell you about them, and then well, it'll be up to you to do. And I think when we break into smaller groups, it's something you guys kind of a topic to discuss. The alert to exercise, the exercise that you should do, and if you worked for me, you would do it, and that would be to take the video clips under a certain topic. For instance, let's say the ones that talk about the liens that are in the market. Write down in real time the time and dates that you see them happen, that you recognize that particular instant worked or was just recognized by you. It'll kind of unbelievably allow you to get confident in seeing them, and it'll become second nature. So it's one thing to watch them over and over again on a recording, and that's important. That's why they're there. But then to be able to see them yourself takes the training wheels off, so to speak. But you got to do that exercise. So you got to write down and just keep it. It doesn't have to be all the order flow examples, but just for instance, the lien. When you see a lien come in and when it gets taken out, the market flies through it above, a big offer, gets through that big offer, it races up or races down. Write down the time and dates, not for us to go over, but, for yourself to review and go over. And then if you're in the small groups, that could be a topic, like I said, to look and say, hey, did you see this one or that one? Or, yeah, you know what, I should have seen it, but I missed it because someone else seen it. If two guys are doing the exercise and one guy sees it and another guy doesn't, it's safe to assume that you missed it. So it's important to follow and determine the stuff yourself on your own, not just to take the training wheels off, but also the instances where you might have missed it. And someone else could say, yeah, you missed it. I mean, you shouldn't miss it. Or you want to minimize the time you miss good stuff, important stuff. These transition. Did you miss it? Did you miss in real time recognizing a change in bias? Everybody wants to know how to create a bias. BS. How do you change it? That's what's important. So that's what we're going to go over today. Then I'm also going to upload a kind of a long 10-minute video clip that we had. I'll upload it. You guys could look at it, and it was of a particular instance that it'll be a new video added to the file cabinet, which is the last set of videos at the bottom, very bottom of track 3 when you scroll all the way down. Make sure you're logged in. So moving on to the next slide. When and how do you call a transition? All right. Well, first off, if you noticed the videos, lessons like what, 8 through 11 with the setup, head fakes, rejection, good support resistance taken out, the long up down bars, a lot of those videos, if you notice, those are the reason why they're setups is they're transitional. They're ways to accurately find sooner rather than later a change in bias from the market. Again, that's when the fruit is the lowest. That's when you'll have an edge over your fellow trader. Your fellow trader knows it 20 minutes after the bottom is in. And they're like, yeah, but they buy it too late. So you want to get the sweet spot. If you try to call it too early, you can get run over, and that's fine. But if you call it too late, the opportunity is gone. If you call it too early, if you're good at managing your risk, you can get out of a losing trade. But if you call it too late, then you might be in trouble because you're frustrated and you bought it and you lost money. It's better to lose money when you take a shot and you manage the risk and you were too early than miss it altogether. You were right, but you bought it too late and you lost money. It's almost like the first way you're swinging, you're taking punches and you're just getting hit more than you're hitting. The other way is you're afraid to punch and you're just getting beat up, and then when you finally decide to punch, you get knocked out. You were late, you lose money, and you miss the opportunity. At least the first way, and let me draw this on here real quick. See, the first way, that pen's not going to be good. The first way, if you're calling a bottom and the market's moving down like this, and you think, wham, it moves out of the hole, and you think the bottom is in, so you try to buy a pullback to here, and you manage your risk, but you lose money. You were wrong. The market still slid south. At least you took a shot, and you're being, if you're right, you're ahead of the curve. If you, let's get rid of that. If you see the market, bam, fly out of the hole, it goes down like this and goes up like this, and you buy it up here because you've seen it, it's like, then it comes down like that, shakes you out, and you lose money. It's like, well, man, I missed buying it here. I missed the opportunity, so I'm mad about that. Then when I take it, I lose money, so I'm mad about that. You're mad about two things. And knowing that you can manage your risk will help you pull the trigger easier. Knowing that it's okay to be wrong and you feel a little bit better about that will help you execute, will help you pull the trigger. Good question, Tom. Let me get back to it. All right, now here's another. So these are like the videos, right? The transitional videos, and that's what they're about. But it's the uh-oh moment that you would have, or that the market would have, right? If there was a sound that was heard from the market, it would be uh-oh, and there'd be maybe some swear words included in between the uh-oh. It's when the you-know-what hits the fan. And so when you see that, or you could rather hear that, is a transitional moment, or your best chance for one. So let's go to this sketch pad, and then I'm going to go over some on the chart from today when it's fresh in our head. The head fake is just you identify the consolidation high, you identify the consolidation low, and you're chopping, and you know that the market's going to go up, doesn't follow through, quickly comes back, and you could predict that the market transitioned from bullish, which right up in here, to uh-oh, not so bullish. That's a head fake. The rejection is the market's just going down, making lows, and then wham, all of a sudden you get that V-shape rejection. Drew gets slapped in the face by the girl he's trying to pick up. Now he knows she doesn't like him. That rejection usually has a pullback and then a continuation up. This is when the bears said, yeah, we're in control, and no, we're not when it quickly rejects and runs up. That's a rejection off the low. An upside down V would be bam, coming off the highs like that quickly, where you could say these highs, at least temporarily, are rejected. Another way is when the support or resistance gets taken out. So you're moving up on a chart and you got good thin spots right in here, and the market comes down and zips right through it. That's a great transitional moment. Heck, today I got long because it was a good spot, I got the heck out for no loss because I felt the bias was changing. And it did. And we ended up going all the way down, taking back the rally. So those are good bias changers. Another one is the long up down, right? So you just go down, you go down, you go down. It's bearish, it's good. Goes up, goes up. It's still bearish. Goes up. Well, still maybe bearish. Goes up. It ain't bearish no more. Something changed, and everybody who thought it was bearish is now stuck, and they're stuck short. And so the market goes down, goes down, goes down, and usually is able to curl up. And you had the uh-oh moment in this bar, right? In this bar that kept going up, 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 up. Uh-oh moments or the sounds you would hear if the market is about to change. When everything was trading on the floor, you had that. You had that moment. You could kind of dictate. It was kind of like a, what's the word I'm looking for? You could kind of get a sense from the sound that the market was turning, and it was kinetic, almost type of intuition. You think it was intuition, but it was actually you were in touch with your surroundings. But transitional sounds would be a lot of swear words that would happen. So those are like the drawings of some of those lessons, just to kind of get you in touch. I wasn't going to do the topic on this, but again, if this was a class that we had every Tuesday, you guys were around, this would be the topic of what happened today. And it would be a great way to review today and help prepare for the next day we have, either like this or there's these moments almost in every day. Some of them have them more than others, but today was a good example of it. So let me go to the charts. And let's just look at a 4 PNF. Let's bring it across. And let's take it back to the open today. Oh, I have no. Get rid of these lines. Where the heck am I? Oh, that's fine. There we go. So let's just go to, what did we open today? You guys remember? 70. $74. We opened at 74, roughly. All right. So let's just put that line up there. And then back it up. What am I, on the wrong day or something? Yeah. All right. There we go. All right. So we did open up. Let's take a look right here. Now, George is the one that made this call real time. We open up in this area where my cursor is. Let's go to a different color pen here. Go back to yellow. So we open up And it was like, this was before the open. We open up and we had some tempo attached to this move down. Like it went down pretty quick after the open, if you guys remember, like 5 ticks. And it's like, wow, we're going to break through the bottom of this consolidation, this low, this low, this low. And it comes back up, holds the open, wham, comes back down. All fast reactions. And you had that line and that sell-off all lined up, and that bearishness and that chance to sell the open in there. Let me try it again. Just all that good tempo to make us think we're going to take back some of the rally yesterday. And we're weak, whatever. We're going to go down to this low, which was the overnight low. Because everybody is always worried, are we going to test the overnight high or test the overnight low? What's first? It's in a lot of people's minds. So, boy, it looked like it was the overnight low going to get tested. And then wham, this bar happens. But before the top half of this bar fills out, like right in here, so none of this happened. Look at the speed. You can see it with the greens that we fly right through 74. In here, it was a transitional moment. It was a change from going, we're going down, uh-oh, we're not. And so the next side being the right side, or saying up, the next side, the upside's going to be the right side, was the right way to call it. Where does it come back down to and hold as support? The thin spot. And that's where I got long. I think 75 quarters off this thin spot here, off where it got quick, moving now up. Rotation, continuation. But the transition, catching it early, but not too early, not too late, was important. Now, here, let me go back a couple bars. If I would have said, yeah, George, you're right, I agree, we flew through the open like this, let's get bullish, and I said it and bought it here, what do you think is going to happen? I'm going to lose money, and I'm going to be right. So you got to know, where can I get in? Where's a good location? So then the market continued up. It challenged the overnight highs right there. Actually, didn't we have a skip up? Got real choppy in here in the next 15 minutes, back and forth, no transition. And then, bam, we had that. We had a big move to flush out all the people looking for it to go down in here. Wham, a quick move up. Actually, it was right here. This quick move up was right in here. All the way to 81.75. Then the long down bar happens. If you remember, if you were in the room, this is the one I tried to buy to the bottom part of this green strip that got let out on the way up. And it spent a lot of time. Look at all this volume it spent around in here. I was able to have time to get the heck out because I felt like if it doesn't bounce right away, this is developing into a long down bar, and the bias would have changed again. All real-time analysis. And what happens? It comes back up, real-time, or right side's now the downside, so it's in a proper way to change the bias. Comes back up to 77 quarter. I think I even sold. I think I got short there. Downside's the right side. Goes to the open. Shoots through the open. It's bearish. It's bearish. And then wham, look how fast it not only comes up out of the hole. George had a line down in here around 72 quarter, but it wasn't like, all right, that's going to hold, and you know that right here. But when you see this come up this fast and just blast through the open, not hold any of this thin spot, before it gets to here, you got to know the bias has changed once again. And the upside is now the right side, or has a high probability of being the right side. Damn thing comes right back down to the open. I was mad that I didn't try to trade the open or buy it on this pullback, because we were left with a nice move up. I think I might have caught a pullback to 75 to this thin spot. So the market goes up really fast where my cursor is, rotates back down, and then re-rallies. Market now still upside. There's no transitions. The market chops sideways. There's no indication that the market might go down. This market comes down a little bit too deep, and you might say, well, is that a pullback that's deep enough? Doesn't come down too fast, hangs there, and you got to look and say, they're still, as long as they're above where these bulls are keep coming in to defend, it's okay. And I said, I'm on the edge of a cliff, but I think that with the way the tempo is going, I bought it here because the line in the sand where the bulls were still right was where this yellow line was. If it leaked down in here, I was in trouble. But I took a shot, and I knew what my risk is. I knew what my out was going to be, and I knew that there was no transition lower yet that had showed itself. And sure enough, the market was able to make higher highs, runs up, comes back down to the thin spot, holds it, re-rallies. Chops around, shoots back north pretty aggressively. This is a long bar down. So what do you think we're thinking now? Knock your damn horns off. Big rally up. Great. Everybody's bullish. The little Johnnies of the world. Comes back down, fires through that thin spot, fires through that thin spot. This is the thin spot I want to get short. And I had said it. It's going to set the top of rotations, this thin spot right in here. For two reasons. Number one, you get a long down bar that's got the bulls nervous saying, uh-oh. And number two, this is where about they said, uh-oh. Where they said, uh-oh, is going to be subsequent resistance in this case. Two rotations to that thin spot. Downside was at least the right side to the tune of a few points. Then it goes back into some chop. But where do the bears stay in control? As long as they keep it below all these reds, they stay in control. They stop it there, they stopped it there, and they keep the ball. This would be a potential transition where we're going to maybe go up. If they hold these greens in here, the bears now don't have the ball anymore. And I'm going with the bulls. And the market wiggles back higher, goes into some chop. If it gets through the bottom of this consolidation, I'm a fan of the bears. If it walks back through the top, the bulls have the leash. And they slowly but surely are able to drift it higher as we come right into real time and where we're at right now currently. This extended chop shouldn't surprise you. Time of day, Europe is closed. Kind of an uneventful, unopportunistic chop. Do you play momentum? Anybody that would say to me, Anthony, one rotation, two rotation, three, why wouldn't you want to play momentum there, momentum there? Well, look at it. It's 11 o'clock. You want to play momentum overnight? Do you want to play momentum midday? It's just a lower probability you're going to get momentum midday. So it's just a riskier trade. That's all. The only time momentum is good midday is if it's a very busy day. So it's context of when to play a range breakout. Midday is not always typically the best time to do that. Right now it's just kind of sloppy. They're just chopping around 82 and 80 and 79. And A lot of people will try to find out reasons and rationalize it's just trying to redistribute this or that. Listen, there's just nothing going on, right? There's just nothing going on. The game, hasn't restarted. It's like in between periods in hockey or in between innings in baseball. Nothing is happening right now. There's no opportunity to see, what team has the momentum. So why try? So I touch on this a little bit in the room, and I thought it would be important, and it is, to kind of hold a kind of a longer webinar. So now it's recorded. You guys could kind of review those transitional moments. But I'll attach on. I mean, if I had an actual group of 10, let's just say, prop traders that were junior traders that were being backed, I wouldn't throw too many exercises on them because I would want to make sure that they were doing them. The one would be, I want you guys to write down the time and the date you've seen these order flow instances happen and what happened. If you're not recognizing them, if you don't prove to yourself you could recognize them in real time, you always have training wheels on. Same thing with these transitional moments. If you can't recognize them and write it down and create an exercise of it, you'll always have those wheels on. Is this one? Maybe not. And then talk yourself through the story of it working. Build the context. Tell the story yourself. But that's another idea for an exercise, is to write down these transitional moments. I call them setups, but they're setups because they're transitional opportunities to see a change in bias. And a change in bias in anything in life is going to be where the most opportunity is when you can find accurately or high probability wise where in the conversation of trying to pick up a person at the bar, where in that conversation it's a yes, that transitional moment. Because you could screw it up if you had a good high probability moment where it's a yes, I'll give you my phone number, and you're still pressing, going a different direction, you could screw that moment up. You got to identify. You got to get good at it. In a more micro or a macro example, the housing market. What was the best opportunity? Let's go back to the sketch pad. What was the best opportunity in the housing market? Let's go to this pen. In the housing market, and I'll go back to your guys' questions in a second. The housing market meltdown in 2004, the Senate Banking Committee looked at a bunch of big bankers and says, I hope you guys know what you're doing. I'll give you 12-to-1 leverage. It's forever been 9-to-1, so they increased it about 30%. So that put all kinds of money in the pipeline, and everybody who wanted a loan got a loan, and that just shot, because demand went up, shot prices up. Well, you ever see one of those rides, the centrifuge type of idea, the ride that you go around in a circle and the floor falls out and everybody's plastered against the wall? Well, imagine if that's what happened with the housing market, is that they just went so fast, but when they stopped that ride, imagine if they just stopped it and just the brakes went on and the ride just stopped. It'd be deadly. Everybody go flying around. You got to slow it down slowly and bring the floor up. Well, they didn't bring the floor up and slow the ride down. They just said, that's it. When you say that's it, not only, and I don't want to get into the whole rationale for this crisis and why it took place, but when they took the rug out from underneath this market, not only did you have people stuck at the top, but the transition to go down happened when all of a sudden the time to sell a house kind of went up and the mortgage apps weren't being approved at 100%, which is what they were approved from 04 to like late 06, if this is 2006. Point is people around 05, 06 put on bets. They thought ahead of when this transition was going to take place, and it was going to be quick, and made billions of dollars in being able to trade, not how we trade, but being able to have macro investments in a decelerating and wicked downturn in housing prices. So the opportunity was when that sentiment started changing, to anticipate it. Something scratch your head moment. Now, going forward, you had the market go all the way back down to, let's say, whatever price that would be, and run back up to like here, and you say, that was the bounce, right? But it's too late. The bounce happened. What was the transition in here? What called that change in bias down there? And it was in around 11 when mortgage apps started to get approved at more of a normalized level. And that's what real smart people waited for before they started to pour back in and buy foreclosures. So when they seen a slight uptick, not a big uptick, but a slight finally uptick in mortgage apps being approved, because mortgage apps went from being approved at around 5 out of every 10 would get approved to 10 out of every 10 would get approved. That's the bubble. To 2 out of every 10 getting approved. That's the disaster in prices. Well, when they started to go like back to 3, 4 to 10 mortgage apps that's when price followed up. That was the bottom. I guess the point of the whole story is the most opportunity is always going to be at the turns. I was approached in hindsight. I knew that was going to be a no miss investment in 11, and I was approached to do it, but I didn't want to get in. I didn't want to get into that business. I had bad experiences with rental properties, and I just didn't want to deal with that side of the business. But I knew it was a high probability, decent shot, decent trade, if you will, because the turns are always, where the opportunities are gonna manifest. So as you break it all down, so is it going to be in the, predicting the turn in a chart and then seeing a subsequent location to get long or short. Dan says, who's an appraiser, it's rotating back towards disaster. What's the tell on that, Dan? Dan's a appraiser. So the bubble is starting to expand. 0% down payment is back. But haven't they learned their lesson? He says no. When there's a money train and everyone's on it, the blinders don't go up, the veil goes up. So like in 04, 05, 06, do you think people said this can't continue? Everybody I'm getting approved for a loan, this guy has no documentation, he has no down payment, he has no skin in the game in this house, and he's getting approved. Do you think the realtor cared, mortgage broker cared? When you're making money, everybody in the process is on the money train, and the fact that there's a mountain right ahead and you're going too fast, nobody sees it until you hear the crash. That's where how bubbles happen. I would think that there'd be a big time that would elapse between a next bubble like that, where the memory fades from the people who lived it. Because if you think about this, it's not ironic, or it's not coincidence that in the late 20s is when the Depression happened, and it went through the 30s, okay? And it was World War II that got people back to work and kind of pulled us out of it. But all the people in this generation are gone. They know what the bubble that created the Depression, which was installment payments, and it was the the, hey, you don't have to pay now, pay for that vacuum cleaner in 6 months. And that advance on credit created that bubble. Now all those people are gone, that generation who lived it are pretty much gone when the next bubble happened, which was whatever, 80 years later. Fast forward 80 years and the next bubble happens, and it's not vacuum cleaners, it's houses. And I really think, I'm not a big fan of the government doing everything. However, I lived through 9/11 and traded it, and I lived through months like September and October of '08. And if they didn't do anything, things would have been a lot different even today. I think more people should have went to jail than went to jail. But as far as like public money bailing out different, whether it was Fannie Mae or Freddie Mac or the Fed lowering rates, you had Bernanke. I think you had two guys, Paulson and Bernanke, two best guys when history is written, at the helm of Treasury and the central bank. That could have been. Bernanke was a student of the Depression, and nothing was really done. I don't want to turn this into the mortgage meltdown, but when people are gone from who lived a bubble, then you get the greed to recreate that bubble. And that's why markets move only in a more micro fashion. That's why it's worth talking about it. Because the bubble, if you to physically see a bubble on a chart or as we trade, it just gets big, small pops. And those are the turns. Too many buyers, that's too many longs, got to go down. Let me go over some of the comments and questions. That was probably the bottom, Dave. All right, so Tom had a question earlier about, seems to get taken out a lot by the noise and whipsaws. So is it fair to say, Tom, that you're right on direction, but you get shook out? Well, actually, you say that. So he's right on the call and the bias, but he's getting shook out, trying to protect and risk manage his risk. What's your average loser on those shakeouts? And this goes back to how nobody could trade like someone else. So my advice would be the price of poker might have to go up a little bit. You might have to risk a little bit more to make a little bit more. If you're right on the call, that means you eventually get paid. It doesn't mean triple your risk. It doesn't mean that all of a sudden, in order to make this a success, you got to take a lot more risk, but you're going to have to open up a little bit. If you're right a ton, it's happening a lot, and you're eventually right. Also, you're doing actually what I would recommend is opening up. Going back to, it's really difficult to trade just like me because I am quick to take one or twos, not physically quick, mentally just quick to say I'm out. I've been really good at the stupid trade type of mentality. It's just another trade, just a stupid trade. It's not that important. I don't care. If you thought like that when you went out and bought stuff, you'd overspend. You got to think like that as a trader. You end up risking less, to me, than those who, you know, end up putting too much importance into a trade, and therefore the risk just goes through the ceiling because they can't get out. Extend your risk a little bit, Tom, but also find your favorite setup. And that's why this is an important webinar. Find your favorite transition recognition. That's what the setups are. It doesn't have to be the specific identical setups as you see lessons 8 through 11. Find one that you could recognize easy. And you're not going to do it unless you start writing down, recognizing them in real time and seeing if you could do it on your own. Because then when George and I bring it up, it'll be like, great. You know what we're talking about. Like I knew what he was talking about when we shot through 74 even this morning. And it made me redirect, and I wasn't bearish at the time, but it got me bullish. And that's the help of listening to people who are trying to watch these transitional moments. To me, that's not even after the trade analysis. See, to me, the work that should be done is during the time, not after the markets are closed, but during the exercises of when they're open. Like you're not gonna after the market's closed, you're not gonna be able to go back and say, did I recognize that pattern? But during the market being open, you're going to say, this is a moment. This was a transitional moment. This was a transitional moment. This was a change in bias. And I think that it's going to be a clickable moment for a lot of people to find the transitional moments, because those are the setups. That's when the stuck traders are getting stabbed and screeching out. There's a slaughter. If you're walking by a barn and you hear a lot of wailing going on, you know there's some slaughtering going on. You might not want to be a pig at that moment. You might want to walk the other way. That's good, Tom. That's good. That's a good way to do it. And that brings me to another way to review is off of live footage from that day. So it's recorded, but it's right from that day. So it's fresh. If you were watching it that day, you can go back and replay what you've seen. But write down in real time that you caught it. It's always going to be easier. It's going to be easier to see when you replay the recording and catch it. But in real time, when did you see that you were right? It'll give you more confidence to stay in the trade and risk a little bit more. You gotta remember, the reason why I don't number these webinars is because at some point, once there's enough of them, then I'll put them in a certain order. It goes back to what we talked about, where you don't try to lay out every single piece of content in a course, because you'll never finish it. And then you'll decide, I should have done it this way. That's why there was a certain amount of the course laid out and recorded with the book and the videos, the first 11 videos. But all these group coaching sessions, there's a lot of stuff I want to get to, but then you start addressing things and finding a better way to explain something. And okay, this session should be earlier on in all the group coaching sessions, because that's where I'll eventually place it. So once enough of them are done, then I'll put them in an order I'd want people to watch them. Right now it's the order in which they're listed, but at some point when there's a ton of them done, I'll say this is one that people should watch earlier. Not number one, they got to understand 1 through 11, but then when the classes start, it should be an early one, because it'll help you understand and create less randomness. Transition moments needs to find the turns. And guess what? If you're a trend trader, then this is an uptrend, right? You're still got to find these little turns for opportunities to get in. Because if this is, let me draw this again. If you're I want to trade the trend, and this is what a trend looks like. You could be long in a trend, but you're long there, or you're long here, and it goes up your way and then against you. Those are bad locations. But if you can get long here, or here, or here, closer to the transition back up, now you're on the team, and you're actually attached. You're creating a good location to your bias. And guess what? It was on the turns that your locations are going to be found. If it's in a trend, then it's going to be the pullbacks. If it's fading it, then it's going to be the rejection off the highs. Closer to the rejection off the highs. Not right near it, because that could be on the railroad tracks and you're going to get run over. But closer to the high, so if you're wrong, you're risking a little bit less. Do you notice I like momentum? You know why I like momentum? Because me personally, I don't like to have risk on. That's me. I don't like a trade going 3-4 ticks against me. Now, a lot of people don't feel the same kind of way as me. 3-4 ticks isn't heat. They're long or short in area, and I think that's great. But the point I'm trying to make is that's why I like momentum trade. That's my favorite. Why? Because if they're going to work, they're going to work pretty quick. And momentum doesn't have to be through a breakout of consolidation, like wham, it goes up and try to buy it in there. Momentum could be the market comes up, comes down, and quickly retraces and moves up off the spot. That's why faster markets are more opportunistic, because you're proven right or wrong quicker. So if you're not proven right, then I'm wrong, and it's closer to my entry. So my loss is minimal. Time becomes of the essence. But another real kind of strong reason why you can't try to trade exactly like someone, but you could fit a lot of what they're talking about into some really clickable moments. And that's why I think smaller groups could work. And you know what? The smaller groups won't, this might be the same 5 people in the group. We'll try to keep them where there's enough in each group. And that's why if there's something that we could kind of watch over something and kind of monitor who's where, then it has a better chance of working. But think about a couple weeks. I'll stay in touch with Dave. And for those that are watching this group coaching session on a recorded at some point in the future from now, and it's recorded, what we're talking about might have already come to fruition. But for those watching it live, Dave and I will stay in touch and see our next move into laying up what you're going to need in order to have access. So that's where that is. Any more questions before I wrap things up? If we were in a conference room, you guys were all working at a prop firm, kind of know what to leave with, write down these transitional moments as you see them real time. Go back to those exercise clips and just take one of them and write down when you could recognize it real time. And start, you take the training wheels off when you start saying, hey, I see that one. You're not waiting for someone else to tell you it. You really spike your confidence. I'm going to stop the recording for now. I started the recording back up because Tom asks a good question. Can I differentiate between a transitional moment and catching the turn? Catching the turn is being close. See, a lot of times the turn, I keep changing back the pen. A lot of times, if you see something on the turn, so that's the turn, right? It's going to be hard to catch the turn right at the bottom. The way you do that, number one, is you're anticipating a support level in this case, and something in the dome, like a lean gets taken out, like he was offering it all the way down here, and it gets taken out, and you're able to shoot above it, plus you had support. A big stuck seller comes in and can no longer press it lower. So you qualify it at a support level is the way you'll catch a turn at its best price. That's the most advanced, and you got to really look at the dome and be ready for it to qualify an area of support. That's to catch the turn at its best, meaning lowest price in this example. Okay? But there can be a transitional moment that shows itself after it turns to allow you to get long or change your bias and find a location to get long. It might be, and probably it'll be above where the turn is, like a pullback to a thin spot and then kind of re-rally. So they're both essentially the same. It's just a little tougher. Let me redraw it. It's a little tougher to catch the turn on the turn or at the bottom. You're really going to have to, you're tiptoeing on the railroad tracks. But there could be a quick transitional moment in the dome that you'll be able to say, the shorts right now are stuck. And they haven't been stuck on this whole move down. Let me take a shot. And you could catch the bounce. And then you're already long, Tom, and then you also confirm a transitional moment, bam, because you get that rejection out of the hole. Or a long down up bar. Does that make sense to you? Turns don't happen unless the market's transitioning. They're essentially the one and the same, and don't overthink it. You know, when you see a turn, the market's transitioning. It's just harder to catch the turn when it's happening. Just more advanced. And I'm not saying don't look to do it, but it's not the first. It's going to be hard to do that first. Those are those moments when you're qualifying support and I'm looking for a turn, right? Because if the support's going to work, we should turn and rally. But if you can get other clues to catch the turn, meaning it turned up a little bit, keeps going. Here, let me draw it like this. So you could have the market go down, it starts to turn up and turn up. And now at some point, this long up bar totally retraced this bar in the very next bar, and it's a long down up bar. So now you know that the market's gone from bearish to bullish and you're looking to get long. The transitional moment has taken place to change your bias, not when it gets up here, but when it just retraced this big down bar pretty quickly. So you can look for a pullback to get long and then start executing your bias. The turns are within the transition. It just, there's different qualifying moments. So if you note, there's different moments to qualify a change in bias. I mean, that's what makes highs and lows. They turn off of that, and different clues, I guess. If you notice, the order flow exercises, I would never do like early on in an educational process, either in the course itself, pre-recorded, or in the first few classes, because you got to get used to quoting it or seeing some chart patterns before you could kind of then get down into all these numbers, because you can kind of get confused or overwhelmed. There's a reason why. Well, let me stop recording.